The sky is falling. That seems to be the consensus view from investors after the Fed meeting last Wednesday. Stocks crashed 3% in just 2 days, and investor sentiment is likely to take them down even further. Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, stocks to watch, economic news that could guide the markets. A very important video for you this week because investors just don't seem to see the game the Fed is playing. Now, I say it's lying. The Fed members would say it's just a little white lie to accomplish what they need to happen. I'm going to share proof that the Fed isn't being altogether upfront with investors and why panic selling is the last thing you want to do. Stick around after that. We'll have our Monday market update with the stocks I'm watching this week and the economic news you need to see. First though, if you want to see the stocks I'm buying for the next 30 years, my forever stocks, check out the link I'll leave in the description below. This is a free report I put together with the Motley Fool. The 5 stocks I'm buying for the next 30 years. You'll see that first stock immediately, then get the next 4 by email. The report is totally free. There's no obligation to buy anything, so look for that link in the description below. Back to our main topic though, because you could set your watch by the market last week. Here we are on Wednesday. The S&P 500 was at about 44.52 at 1:45, just before the release of the Fed meeting. The Fed meeting concludes at 2 p.m. and stocks immediately plunged, falling to 44.01 by the close. Stocks would then go on to a total loss of 3% in just 2 days into Friday's close. And what happened to drive that crash is the nation's central bank, the Federal Reserve, updated its projections to expect still one more rate increase this year. But the real pain point was really in the number of expected rate cuts next year, dropped to just 1 on average. As recently as June, the market was expecting the Fed to start cutting rates by as early as November of this year, and then to cut at least 4 times next year. Now it looks like, according to the Fed, that we're stuck with higher rates for longer. In the charts accompanying the Fed release, the group shifted inflation higher for this year and as far out as 2025. So here we are seeing the distribution of participants' projections for PCE inflation. This, again, that's the Personal Consumption Expenditures Inflation Report. Comes out the 29th of each month. That's what the Fed watches for in those inflation expectations. And you can see here, just as recently as June, this dashed line is the June projection, where Fed members thought inflation was going to be earlier this year. And in June, they thought that by the end of this year, inflation, that PCE inflation, would be down to about 2.9 to 3%, maybe a little higher, 3.1 to 3.2%. That's since been updated. So the September projection just came out. That's the blue bars here. You can see that's shifted for this year. Didn't change much for next year. They still see mostly inflation the end of next year between 2.1, 2.2, all the way up to 2.7, 2.8. A couple of Fed members increased their projections for inflation next year, but really where we see that change here is in 2025. The Fed has shifted its expectations much higher for 2025 inflation. Now, instead of seeing inflation come down to maybe 1.9 to 2% by 2025, now many of the Fed members see inflation as high as 2.3, 2.4, all the way up to even 2.9 or 3% by 2025. And that persistence in inflation means they need to keep those rates higher to slow down the economy and beat those pricing pressures. Here we are on the Fed's projection for interest rates. And again, we see the dashed line here is where they thought they would be in June. The blue bars are where they now think interest rates are going to be. Fed members thought that they could lower interest rates, which are now about 5.5% on the target rate, all the way down to about 3.6, maybe even 4.3%. So lowering rates by more than 1% by the end of next year. Look at these blue bars though. They now expect the Fed funds rate to remain above 5% for the entire year. So with that one report, the Fed says that it's increasing its expectations on inflation and interest rates for longer. I'm going to show you why that's air quotes here in a little bit, but those higher interest rates for longer than expected hit stocks on multiple factors. First, it's just going to choke off economic growth as the cost of borrowing stays higher. If raising rates at the fastest pace in 40 years, if that was like the pile driver that crushed growth stocks last year, holding rates higher is the chokehold that's going to make the economy tap out. Those higher rates are going to be a real problem for corporate earnings and the outlook next year. Companies are going to need to start refinancing that debt that they put on a few years ago when we were at near zero interest rates. But now we're going to see their interest expense surge because they're refinancing that debt, those bonds that they issued, refinancing those at much higher rates. That's going to hit expectations for earnings per share. Finally, those rate hikes and the higher interest rates also mean that lower stock valuations when using a discounted cash flow model of valuation. Okay, remember with the discounted cash flow model of valuation, how you how you figure out what a stock is actually worth given its future cash flows, expected future cash flows in the future, is you take those future cash flows, you model those out, and then discount those by an interest rate to get a present value, a today's value of those dollars. Well, as that interest rate goes up, you discount those future cash flows by much more. That's why those tech stocks and the growth stocks are getting hit so much harder, because so much of their valuation is in the future, is in those big future cash flows that we're expecting. So we're discounting those by that higher interest rate now. The valuations have to come down on those. But hold up, Chicken Little, the sky is not falling. The Fed is just saying what they want you to hear. I say they're lying, they would say they're just playing that monetary policy game. And part of that is just keeping investors on notice for higher rates. If they were to preview those rate cuts before inflation has come down fully, then the market would kind of doubt the Fed's focus on prices. They would lose that credibility. Investor enthusiasm for those coming rate hikes would send stocks higher, and the economy wouldn't slow down to the point that it needs to eventually bring down inflation. So it'd be kind of a self-fulfilling prophecy. Basically, the Fed needs to just talk tough on interest rates and inflation to make sure that the message gets through, scares the economy and inflation lower. In fact, in that same meeting, the Fed did up its forecast for economic growth and lower its projections for unemployment next year. So this is all playing into that story of a soft landing, right? That the economy is going to weaken just enough to bring inflation down. It's not going to put us into a recession, though. But if the economy does weaken further than expected, and I expect it will as student loans hit consumer spending, as the job market softens, then this whole story is just going to go out the window, right? And the Fed is going to be forced to cut interest rates sooner. That's going to suit Fed officials just fine, though, right? In fact, it's what they're expecting, I think. It's going to mean that they've done their job, they've slowed down inflation, and can now get back to that easy money that they all love with those lower interest rates. This should all be obvious if we look at the history of interest rate cuts. Since the 1970s here, you see interest rates have always fallen quickly after a rate hike cycle as the Fed chokes off that economic growth and must then reverse its course. So the Fed increases interest rates quickly, it kills the economy, and then they have to lower interest rates to support the economy after that. In the last 18 months, the Fed has increased interest rates at the fastest pace in 40 years. If we look at the current interest rate projections from the Fed, that's this beige line here on the right of the chart, the Fed seems to be saying that this time is different. It's expecting rates to come down only gradually, even through 2025 and beyond. But we know what happens when someone says this time is different. It always ends up being the same. And besides that slowing economy, we're about to start seeing inflation come down faster than expected. That's because the persistence in price pressures. Okay, so that stubbornly high inflation has been almost entirely a part of the CPI known as owner's equivalent rent. This is a shady, estimated measure of housing costs and has never been really well measured. And it also lags the market by as much as 6 months to a year. Okay, without this OER, we can see here in this graph, this core HICP, that is the consumer price index without this owner's equivalent rent, without this weird measure of rents and housing costs. Without that, consumer price inflation is already close to the Fed's target of 2% a year. And that slowdown in housing cost inflation that we've seen just this year, that's going to start bringing that overall number down fast. Okay, we see this core PCE, the core CPI numbers here in darker blue. They're still very high at 4.5%. Without that owner's equivalent rent, that is actually much lower, almost 2%. And we're starting to see rent come down. That's the fact that that's lagging is going to bring down these other two. We're going to start seeing these other two measures of inflation come down very quickly. And okay, before I get a lot of comments on this, because I always do when I start saying that inflation is coming down, and people say inflation is not falling. Don't tell me how inflation feels, okay, folks? Yes, it feels like prices are just running away. Even Walmart down the street here in Tampa wants $3.60 a gallon. Hell, I watched a Twilight Zone episode last night that showed gas at 35 cents a gallon, and I had to cry just a little. But the fact is, compared to inflation going up 9% last year and 4 and 5 and 6% this year, it is now increasing at a slower pace. Okay, yes, prices are still going up. If inflation is going up 2 or 3% a year, that means prices are going up, but it is going up at a much slower pace than it was last year. That's what the Fed is waiting for. That's what the Fed is expecting to be able to cut interest rates, is that pace of inflation slowing down. So yes, prices are still going up higher, but not at that same pace, and that's what's important here. So then that slower pace of inflation, the weaker economic growth that we're about to see, means the Fed is going to be able to cut rates sooner than expected. it's going to become obvious that the Fed was just playing that game, talking tough on inflation and rates, and that interest rates are going to fall quickly, just like they have been in the past. Now, understand that might not keep stocks from feeling the pain for one more month. That change in rate expectations really depends on two things: the jobs market and inflation. We get the jobs report just once a month on that first Friday of the month. We see inflation readings, 3 of those a month, with the CPI first out on the 12th. The PPI is usually on the 14th, and then the PCE is on the 29th of each month. It's going to take multiple reports of these to really convince investors that the Fed is lying, that the Fed is going to cut interest rates much sooner than expected. So this is not going to happen overnight. Stocks in the S&P 500 did reach about 4,600 there in July. They're now about 6% lower on this pullback. We could see a correction of as much as 10%, I think. Just take stocks down to about 4,140 on that S&P 500 index, but that would likely be the worst case scenario. Okay, I'm not expecting stocks to fall more than 10 or maybe 11, 12% at the most. With the sell-off that we've already seen, with that progressively weaker jobs market, the progressively lower inflation reports that we'll get over the next few months, I'm getting more bullish and selectively buying into the weakness. Folks, do not be panic selling your stocks here because you think we're going to be in a full-blown stock market crash. This is just a correction, and it's going to lead to better opportunities. I want to open it up to the stocks I'm watching this week. First up, Nike, ticker NKE. It's going to be reporting its third quarter earnings after the bell on Thursday, following a big miss in last quarter's report. We can see that here. If we scroll down on Yahoo Finance, we can see the history of earnings reports and whether they beat expectations or earnings miss. Usually Nike does very well, usually beats expectations. It did miss last quarter, which shocked the market, sent it down to nearly 8% in the week following that earnings miss. Revenue in China is still likely to be very weak, but the gross margin and the operating margins, so those two key measures of profitability, those are likely to have improved over the last quarter. With the lowered expectations following this year's weakness and just potential for restocking low inventories into the second half of the year. So inventories were building up. They have since sold off a lot of the inventories for the company. They should be in restocking mode here into the last half of the year. There's a good chance for a surprise upside on any good news here. I think expectations are low enough right now. The lowest of 29 analyst estimates for this stock are a target of $88 a share. That's just 3% lower. So the lowest analyst target is for just 3% lower, while the high target of $150 is 65% higher from here. So I think the risk-reward trade-off for Nike here has turned positive. I'm also watching SoFi Technologies, ticker SOFI, at $7.54 here in the sell-off. It's a long way off from that 52-week high of $11.70 we saw there in July. That sell-off of 35% as the stock comes back down with the market. It's also, though, a long way from the $4.24 low this year, and really, I think, a second chance for investors that missed that run, missed that rally in these shares. SoFi is going to continue to grow as a bank, folks. They've got a banking charter. They can collect those deposits. It's a full-service financial company. This is still a very small bank at just $12.7 billion in deposits, but those deposits grew 26% in the second quarter. Think about that, okay? At a time, the banking crisis that was knocking deposits off, nearly every other bank, nearly every traditional bank was losing deposits. This bank grew its deposit base by 26%. It just participated in its first IPO as an investment bank. More deals like that are going to create another revenue stream for this company, and I think this bank is going to go a lot higher in the future. I also want to talk about NextEra Energy, ticker NEE. This utility company is trading for just 16.5 times on a PE basis. We can go here to the statistics tab and look at the history of this stock for that on that PE basis. And you can see here, that is a huge discount to what it was trading at just last year. The 5-year average for price to earnings ratio for this stock is 40 times price to earnings. It is trading at a 59% discount right now to that average. Okay, utilities have been slammed hard this year on those higher interest rates, but these are still regulated cash flow machines. Okay, NextEra Energy is going to benefit from that faster growth in renewables over the next few years. That's going to be helped by that Inflation Reduction Act spending that's going into renewables spending. That could help protect your portfolio as well over the next few months as the market wobbles. So I really like the utilities here, especially NextEra Energy, on the fact that they're going to protect your portfolio as we see that stock market correction unfold. As we see the rest of the market go down a little bit, we're going to see utilities hold up relatively well, and these are really good value plays for over the next few years. Taking a bigger picture view here with the sectorspider.com, that sector tracker, we look over the last 5 days. For over last week, we did see that all 11 stock sectors closed lower with a really particular pain in that consumer discretionary stocks, just on that fear of a slowdown in consumer spending. Also continued crash in real estate stocks on those higher interest rates. The few safety plays here in the market were mostly in insurance companies. So if we want to look here in the S&P 500, what we saw last week, if we go to the S&P 500 index holdings, the best performing ones, highest was 5.25% there by the CBOE Capital Markets. But if you scroll down here, then you see a lot of insurance companies here. You see Humana, you see Allstate, you see Assurant, you see United Health. So life and health insurance companies really outperforming over the last week, just really on that stability in cash flows for insurance companies, but also the fact that higher interest rates means higher return on their huge cash reserves that they have to hold. And folks, I know after a drop of 6% in 1 week, you'd have to be crazy to be jumping into real estate stocks right now, or maybe crazy smart. I'm not increasing positions just yet, but there is reason to believe that real estate stocks will have a dramatic rebound starting early 2024. I'm going to share my research in this Wednesday's video, okay, coming up. But as we get closer to those rate cuts, and those are likely closer than the market expects, remember, then it's going to draw out the deal seekers on Wall Street. The Wall Street Journal is reporting that hedge funds and private equity firms are already fundraising to take advantage of this drop in property prices to the tune of billions, hundreds of billions of dollars ready to put into real estate deals. With real estate stocks down 25% last year and 6% this year, prices are getting attractive and yields are going up. There's likely more pain as the market adjusts those higher interest rates, but investors should start researching some of the REITs that they're going to be buying into the next year. Again, I'm going to share this in next Wednesday's video. For economic news this week, I think Friday's report on the personal consumptions expenditures report, that PCE inflation report that is followed most by the Fed, I think that's going to be likely a mixed bag, and why I think the market is going to have to wait for at least another couple of weeks to really see those interest rate expectations change and support stocks from here. It's not going to be much help to the market. While core inflation is expected to come down a little bit to 4% versus 4.2% annual pace last month, the personal income part of that report is expected to be up 0.5% on a month-over-month basis. That would be just over 0.2% last month. So it looks like personal income is going up. Higher income would be a good thing normally for consumer spending, but it's also a sign that inflation is really feeling that effect from wage growth. Okay, so pushing wages up and pushing inflation up overall. Personal spending, though, is expected to slow down to a 0.5% pace versus a strong 0.8% month-over-month pace last month. So we're seeing wages go up, our income go up, and pushing inflation up, but consumer spending come down. So that's going to be a negative for the economy. It's going to be a negative for stocks. Basically, the PCE is likely to show that inflation is moderating very slowly, but that wage growth is keeping it higher for longer. See those top 5 stocks in my portfolio, my forever stocks I'm buying for the next 30 years with the link below in the description. Or click on the video to the right for the 5 monthly dividend stocks with the fastest dividend growth, one increasing its dividends by 22% a year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.